I'm asked all the time, do we trade options? And we do. Now, trading options is a bit more difficult in our view than trading futures. And let me explain the difference. When we're trading futures intraday, from one day to the next, they're highly liquid, meaning the difference between the bid and the ask is very, very tight. And we're merely trying to get the direction right, up or down. Now there's some other considerations, but for the most part, that's it. When it comes to options, you need to not only get the direction right, you need to make sure that you get the timing right. Because if you are a buyer of options, if you are putting on debit spreads, time is working against you. You want to make sure that you don't have too little time, that you have enough time, but not over the time. If you're doing a credit spread, you want to have plenty of time because time is on your side. You also need to be concerned with the implied volatility. If the implied volatility is too high, you might overpay if it's a debit spread. If it's a credit spread, you might want high volatility, right? So that it can, once again, decay. It depends upon what you're trying to do. Equally, when you're trading options, you want to make sure that they are liquid. You don't want to be getting scalped hundreds of dollars. And then lastly, when we're putting on options, we're generally not trying to scalp. We're not trading them very quickly. Usually we're not expecting to come in and out of them in the same day because of that lack of liquidity. With futures, we are. Therefore, when you do put on an option, it's important to understand why you put it on, how you structured it, and that you also manage the option. You're going to need to manage it. Manage it for a profit and maybe even manage it for a loss. Let me give you an example of an option that we did last week. Now, on the face of it, it may appear that we're in poor shape. But the reality of it is we're in good shape. But I need to manage it and need to understand what I did, why I did. I'm going to explain what I did and where we are. Stay tuned. Okay, the trade that I'm about to come back and give you an update on is the trade we put on for Goog. Where did it come from? We got an indication to buy Goog from the SMC Stock Market Caddy, not Cade, but Stock Market Caddy Trade Generator Pebble Beach Triggers, and it was down in here. It was trading at about 22.60, and we wanted to get long. We were expecting a bounce. The implied volatility had gotten below normal as it had sold down and had gone a bit sideways. And we knew that earnings were coming up on July 26th, and we thought that this entire move down may have exhausted itself and we could catch ourselves a nice squeeze going into earnings. And it did just that. But we're basically flat. And I want to show you the trade, how we structured it and why. Always open for suggestions. We should have, maybe done something a little different. But let me show you where we are. Okay, so we're going to open up. Here's the trade right here on Goog. We opted for a vertical call spread, a debit spread. We were purchasing for July 29th with earnings on July 26th. No intention of holding it that long. Let me break this apart. I'm going to break it apart to show you. We purchased a July 2260 call. The trade cost was $11,000. Very expensive. Now, the very next day, Goog exploded higher. And that option is worth $7,730 more. Now you might say, geez, that's great. Well, it is. Okay, but be aware, when I put that trade on, it was at the money. And the delta was 50, meaning 50-50. Just as easily as it popped up, it could have popped down. And if it did pop down, I could have been down $7,000. That wouldn't have been so good. So what I did was to reduce this cost and to mitigate risk. At the time we purchased this call, we went up to a strike price of $23.25. And we sold that call, which is a short position for the same time frame. And for that trade, we collected a credit, $7,790. A credit, thereby reducing the overall cost. Now, how did I decide to sell the call at $23.25? Let me show you. When I bought the call on Goog, it's not here any longer, but when I did, it was in panic sell. It was down in here. The trend axis was around that strike price that we sold. Let me show you. This price right here, $23.25. That was right about the trend axis. But also, when I bought this call, the delta was at 50. 50. Could go up or could go down. The delta on the 23.25 was at about negative 20, which is about where we like to put the other leg on. For the most part, our spreads, whether they're debit or credit spreads, we're putting them on at the money and giving us a delta of 50, and the other leg is usually with the trend axis in the middle and the delta approximately 20. But let me put these two together and explain what has happened. Here it recognizes the two legs together as the vertical, as we saw. The total trade cost has been knocked down from $11,000 to $32.80. So that is our maximum loss. And our maximum profit is $32.20. And our risk reward is about 1. Despite the fact that Goog has run up well beyond, and let's pull it up here. Bear with me. Okay, so that is what we paid. So by the way, if our strike is $22.60 and that is what we paid, you simply add what you paid to the strike price, and that gives us the break even at $22.92. But Don, I'm confused. How can you be down a little bit when the price is trading well above the strike at $23.98 with 19 days to go? What's happened is it exploded. It exploded. So we are in good shape here, but what has to happen for us to get into the money is that ideally Goog needs to continue to go higher, or at minimum, stay above my break even and let the time erode. So in this instance, time is on my side in that this leg, the 23.25, just needs more time to decay the leg that we sold. And it will decay faster than the 2260. So as the time erodes, and hopefully it stays elevated, maybe even higher, we will begin to get more into the profit. The important thing is to understand what it is you're putting on for options. Why are you putting it on? How are you choosing to put it on? And then managing that option accordingly. If I just puke this out because I'm down 380, I could destroy what we hope to be and expect to be still a very, very good trade and a chance to profit as much as 32.20. Now, I could have structured this trade differently. I could have done a credit spread rather than using a debit spread and buying the call at 22.60 and selling the 23.25. I could have sold a 22.60 put, and then gone down to a strike level giving me a delta of about 20 and bought a put. When you have and that in essence is a credit spread on a bullish, mildly bullish, and I would have gotten both the pricing right and time would have been more on my side. That was my choice to structure it that way. We're going to, in the weeks ahead and the rest of the summer, be showing more and more of our tools, of how to use our tools when trading options. There's a lot of possibilities, and we're going to try to demonstrate various ones, but it's important to understand that when it comes to the options, we're not, at least here, we're not necessarily using the options to do a lot of scalping. They're a little bit more like, we draw a distinction when we're trading futures to be like spear fishing, and when we're using options to be more like crab fishing, putting a pot over the side and letting the trade develop. If you have any questions, feel free to give us a shout. I can be reached at 813-758-8263. Bag it on, stockmarketcaddy.com. Have a great rest of the weekend.